Good morning, everybody. Welcome to the Flow Show. It's Tuesday, and here we are, another day of moves, another debt ceiling rubbish going on. Good morning.
Good morning.
What are you laughing at?
The debt ceiling is such a funny thing, man. Seriously. Every time is the same theatrics and same thing, and maybe we get a government shutdown for a week or two, but who here believes that they're actually going to default? I mean, seriously.
Nope.
Anyway, good morning. How are you?
Yes, morning, mate. You back from the sunny Isles?
I am
Boating
back.
around the Aegean Sea?
I got back in a hurry because both my kids were sick, so that was not good, but it's okay.
Are they all right now?
One of them is. I got back to school this morning, but the other one still has a bit of a fever, so
Yeah. No, well,
it's all right.
Best wishes to them. And what time are you catching it?
Yeah, that's a good point, actually. It's apparently highly contagious. Anyway, no, I'm still okay.
Good. Cool. Right. Let's get stuck into what's going on. I haven't heard from Kay. You all right, mate?
Good morning, everybody. Yeah. All good.
Good to hear it. Right, we shall kick off into stuff then. China's National Bureau of something or other, Securities Statistics, that's the one, National Bureau of Statistics, said that China is not in deflation and that low price levels are temporary. And this temporary low inflation is likely to continue for some time. It's going to continue because the NDRC have announced they're going to cut fuel prices from May 17th. The state set the price for fuel over there, and they're going to be cutting that, so further easing over there. On the data front, we've had some data out from those guys as well. Industrial production numbers and retail sales coming out. Positive numbers overall, but a bit softer than expected. Industrial production year on year, 5.6%, missing the 10.9 expected. Year to date, a little bit of an improvement, 3.6%. Retail sales coming in a strong 18.4, one would say, though, missing expectations. Again, year to date numbers coming in better. So overall looking higher, but perhaps not the strong a bounce as some would be expecting. Unemployment rate a touch better there as well at 5.2%. Over in Japan, and more inflation in the pipe for those guys, because the government is going to approve up to a 42% increase in household electricity prices. And this is a government supposedly going to allow 7 of Japan's major power companies to raise prices from June. And those price hikes will be between 14 and 42%, according to Chief Cabinet Secretary Matsuno. Researcher and ex-BOJ board member at Nomura Research Institute says the power hikes could raise inflation by as much as 0.42 percentage points. So tack that on to what we already got, which is around 3.1%, expected to go higher on Friday. So more inflation in the pipeline there. And again, the government really is in control of the price moves largely in this one. Is that a big jump, do you think, Kay?
Mate, comparing to what I was already paying for electricity, especially in Japan, this is painful. This is going to be painful. I know the government has put stimulus packages in place to soften the pill a little bit, but we have to know that water is very cheap over there, but electricity has always been very expensive, and then one can imagine after the 2011 quake that energy prices have already shot up because they closed virtually all the nuclear power plants. So it is a sour pill to take for the Japanese. So that's going to drive CPI higher, but then I don't know whether it's going to tell the BOJ or give the BOJ green light to hike the rates, because it's the wrong kind of inflation. But I'll leave that in the middle for now. But yeah, it's going to be painful.
Yeah.
By the way, guys, Japan has approved plans to open next generation reactors and all that, but this is going to take years.
Yes, yeah, because in the meantime they gave approval to start up the old ones that they closed down over after the big quake. But I think the first ones are only slated to come online this summer, and the approval was given last year, just to give you an idea. Because the security checks are just much more thorough than they were and lengthy than they were before the big quake. So it takes a year or 18 months to start up one, only after the approval has been given to start the checks. So the new ones, they will have to wait for more years, I reckon.
2030, I think, is the first delivery or something like that. But anyway.
I'm not keeping my dollar yen short until 2030. I know I like trading long term, but I'm not waiting until then.
Yeah.
But I think the overall view is that that's more inflation pressures. You know, we've got wages going up and still to impact. We got this coming in June. You know, the tide is moving in one direction at the moment. That's for higher inflation and further pressure on the Bank of Japan. So, you know, that hasn't changed at all. It's added to it with that news. Coming over to the good old Aussies down under, and some consumer sentiment data out overnight. Consumer confidence index for May coming in at 79.0 versus 85.8 previously, so down 7.9%, as you can see there. So much worse than expected. RBA minutes were out, and not too much significance because we have heard from chapter and verse from the RBA bods since the surprise rate hike. They say the May meeting minutes, further hikes may be needed, but depends on the economy and CPI. And they point out that economic forecast assumed another rate hike. They did consider pausing or hiking 25 pips in the May decision. So pretty much as expected there, the pause that's not a pause. Over in the UK on the data front, we've had some jobs data, which, depending on how you want to look at it, is mixed. So on one side, we've got some inflationary pressures. On the other side, we got some job weakness. The claimant count came in at a quite hefty 46.7k, quite a high number. I can't think the last time we saw a number quite as high as that. The unemployment rate moved up to 3.9% from 3.8 expected and previous. Also on the negative side, the HMRC number, which is if I can remember what it's called the payrolls change, that fell 135,000. That's not on there. Now, some of that can be due to year-end type stuff, people switching in and out of self-employment, so on and so forth, but a big loss there. But on the flip side, the employment change on a 3-month rolling basis, so that will be a quarterly number, rose 182,000 from 160 expected. So there was a jump in people becoming employed. Now on the wages front, things are still looking pretty hot. Average earnings coming in as expected, 5.8% and previously. The ex-bonus number coming in at 6.7%, higher than last month, but not as much as expected. Now, it's important to look at the breakdown with that within those numbers, because there are two factors. There's private sector pay and there's public sector pay. Private sector pay usually runs well above public sector. That rose to 7% versus 6.9% prior. Public sector jumped to 5.6% from 5.3% prior. So that's where we're talking things like the NHS and those sort of public sector jobs, civil servants, things like that. That's quite significant because you very rarely see public sector pay rises those sort of numbers with a 5 handle. I've been watching this a long time, and you know there are a few exceptions, but usually you're running at the 2 to 3% mark if you're lucky. So further wage pressures coming in there, and we've still got some price rises or wage rises to come in from resolved strikes. We've still got strikes going on. So on that side of things, it gives the Bank of England something to think about. Maybe one could call it a touch of a weak report in some aspects on the employment front, but on the wages front, there's still price pressures there, big price pressures there, and that's what the BOE will be concerned about. Now, some of that, as I say, may wash out over the next month as it flips between the financial year end. So some stuff can get shoved around a bit, so these numbers might be a bit jumpy. But overall, very strong numbers there from the wages. BOE's Peel said they raised rates last week because we thought there was too much momentum in the economy for inflation to return to 2%. Sees the risk of inflation getting stuck at 4 or 5% and says we need to avoid this. Would like to think we've done enough, but we need to monitor the risks. He also, I wouldn't say he apologised. He sort of apologised, but he rode back his comments about people being poor in the UK that he made the other week that Bailey commented on at the meeting. Said if he could do it again, he would choose a different set of words. Well, too late for that, chum. Over to Germany. It's the Germans. Let's shut that thing up. Why is that going off all the time? Well, we'll start with Italy, actually. The final CPI numbers there and HRCP numbers coming in a little softer than expected. CPI 8.2%, but still a reasonable jump over last month. Same for HRCP, coming in at 8.7%, missing the jump to 8.8, but still much higher than the 8.1% prior. So inflation pressures still remain there in Italy. The ZOO was a bit of a stinker for Germany, coming in at minus 10.7 versus minus 5.3 expected, and a positive number last month. Current conditions, not as crap as expected, but still worse than last month. Germany, we were talking about this in the chat room, in the flow room, and Germany seems to be the country, one of the countries in Europe that's facing economic weakness more than the others. And obviously the size of it and their input into Europe means that's a big drag on the Eurozone economy as a whole. But they seem to be suffering more than some of the others, because the data has been mildly better in countries like Spain and Italy. Eurozone ZOO there as well, also worse than expected, minus 9.4 versus minus 1 expected and 6.4 prior. Right, moving on. ECB's Stelios said rate hikes are close to an end. He's one of the on the dovish side of things. He's made similar comments previously, so he thinks we're nearly at the end for the rate cycle there. Coming over to the good old US of A, and yesterday's numbers. We had the Empire State, which quite frankly fell into a fiery abyss, minus 31.8 versus a minus 3.7 expected. However, this number has been a bit flaky of late. It's been up, it's been down, it's been up, it's been down, but when it's gone down usually by quite a strong number. I'll call up the charts quickly and you'll be able to see that there. So we're up, we're down, we're up, we're down, but you can see these negatives are far outweigh the positives, and there's more of them than positives. So things still in the manufacturing sector in the US being indicated by this are very sour and not looking to improve much at all. We do get the Philly Fed, the next one on Thursday. That'll give us a secondary look, but the market didn't like the look of that number yesterday. Now, there's been the old usual flood of Fed speakers, so I'll car through those as quick as. Fed's Bostic does not see inflation coming down quickly. Rate cuts are not part of his baseline. He doesn't expect to cut rates until well into 2024. If there is a bias to action, there is a bit of a bias to go a bit higher, though we are where my dot has been. Banks in his district say that they are going to be a bit more conservative, and so he expects to see a bit less lending in the coming months. That's the nod to tighter financial conditions. He says he's inclined to pause hikes at the June meeting, but the conversation would be different if inflation worsens. And we're obviously going to get another inflation report by the time we get the next FOMC. Fed's Goolsby, this bloke couldn't say anything for the first few months of getting the job, but now he won't shut up and we're getting him daily. A lot of impact of rate hikes is still in the pipeline. May rate hike for him was a close call. Fed's cash and carry said the labour market is not as frothy as 9 months ago, but still strong overall. Fed's Barkin sees no barrier to higher rates if inflation persists. Is very comfortable with the data-dependent approach, but not yet convinced inflation is on a steady path downward. I'm not sure what he needs to see, but it's been coming down for the last 8-9 months. The labour market has moved from red hot to hot, though some secondary indicators point to some easing despite the low unemployment rate. And over to the debt rubbish. Okay, so we were all looking a bit positive coming into this week. We had some weekend comments saying that things were optimistic, constructive, so on and so forth. That's been shot to bits yesterday afternoon and overnight. US House Speaker McCarthy said debt ceiling negotiations are still far apart. He's not seeing any movement on debt negotiations. And to quote, "No, I don't think we are in a good place. I know we're not." US Deputy Treasury Secretary Adeyemo said it's hard to predict when the US will not be able to pay bills. Any US default on debt would have implications for years to come. Yellen, up with her usual, US could default as early as June the 1st without a debt ceiling hike. The actual date for default could be a number of days or weeks later than these estimates. On the meeting that's supposedly be happening today between Biden and the leaders, it's planned for 3 p.m. US time, says a senior US official. I'm not sure what US time that is, but that's probably makes it 8-9 o'clock UK time. Right, lads, get your teeth into that lot. Anything you want to add or comment on? This debt ceiling stuff's shaking the tree a bit again this morning, hasn't it?
Yeah, I mean, you covered pretty much everything in terms of news and data and all that. Just a final word on the debt ceiling. This is exactly the stuff we were hearing the last time round. Oh, we're far apart, we're nowhere close. Sorry to be so cynical, but it's just when you've seen the same thing 30 times, 31st is not going to be different. And there's no reason for it to be different. And there's no upside in those guys for them to make it different. So forgive me, but I don't buy this crap.
Well, what would you buy as a trade? I'm going to do a bit of a Blake now. As a trade, yeah. What would you buy, or what would you get in if you feel that this is going to resolve? What would be your asset of choice?
Well, what has moved on the back of these debt limit fears was 6 months and 1 month. Sorry, not 6 months, 1 month paper, right? So it's a bad risk reward trade. That's a thing. You know, there's a very, very, very low chance of the US defaulting in any way. But if it happens, your risk is massive. So, you know, they theoretically, the trade to do is to be buying, 1 month paper at, what is it now, 6% or something like that.
5.75.
Yeah, I mean, that's a trade. But the problem with that is that I don't like, low risk reward trades, even if it's a 99% probability of it working out. That's the thing. So I don't like this kind of trade. So what do I do? What do I think about other? Well, I'll tell you what. I would be buying stocks because I think this is going to get resolved. And if and when this gets resolved, I think the S&P goes to 4,200 and above. So I would be going long. It doesn't make any fundamental sense in any other way, but I think that's still the path of least resistance, and I think it's going to be resolved, and I think the S&P flies. As simple as that.
Cool, thanks for that, mate. Kay, you any thoughts on that one?
Yeah, I hear what Stel is saying about the 1 month. The unfortunate fact is that you won't get any prices in the 1 month. Unless you're right, then you don't care. You can always hedge it if you want, but you won't get, and then just take your 6% or 5.75% at the end of the road. Yeah, you won't find any prices. I reckon if it gets resolved, yes, stocks higher, risk probably a bit higher. The issue that I see is that if it gets resolved, it should in theory be much better for silver than it is for gold, right? But both will probably start by going down because of I think that if the Treasury will have to increase their bond offerings, and that should put upward pressure on the yields. But in a second round effect, I'd love to buy metals, and especially silver probably. Yeah, and then risk. But if it doesn't get resolved, then I think we're in for a bit of a panic move in a few assets, and yeah, then you're going to see gold, silver, metals in general spike. You're going to see commodities collapse. Collapse is a big word, but go down fast. And FX probably better don't touch it in those cases, because you're going to have everything and its opposite. Yeah, you're going to have like the risk pairs are going to well, risk is going to shoot higher, so the FX risk pairs lower. Stuff like the yen pairs, the euro pairs, the Swiss, still for now. That would be the trade. Now, whether I think it's going to be resolved, yes. Whether I think they are going to resolve it at the 11th hour, perhaps not. Perhaps they are going to do something stupid as to push it back until after the holidays, so you can have like a bit of a knee-jerk effect, and then completely losing steam, because in September we start all over again. So I don't think it's going to be an easy trade per se, especially not if they push it back into September. Not going to be an obvious trade, in my opinion.
Yeah.
Yeah, be a bit on your toes with what risk is doing. And on the dollar, it's kind of a big question. Okay, if they solve everything, people are going to start by selling dollars, because the equities are going to spike and stuff, and that's going to be a risk positive, which is usually dollar negative. But I'll be waiting then, and I'll get my butcher's knife out of my drawer and buy dollars if they really solve everything, because then I think after a few, I don't know, one day or a few sessions of selling dollars because of better risk, it's going to roar back to the other side, I reckon.
Yeah, and I'm a bit confused about gold, because I would have thought gold would have reacted a bit more to the upside on the debt stuff, because I think there's a bit of a premium in there from that, but it's actually lower, so I might have to reassess my thoughts on using that as a debt ceiling trade. But I think you're right. I think the initial reaction is going to be if we get a long can kick. So a 1 to 2 year kick is going to be the bigger market mover than a punt to September. That, you know, we're all in agreement with that. So you're going to get the risk move initially, and then I think you're right. That comes out the pot. The debt stuff comes out the pot, and then we're looking at the dollar for what the Fed's doing, what the economy's doing, where it's a bit masked by what's going on with the debt stuff. So take that out of the equation, and we're back to trading pure fundamentals, well, until the next blow up happens. So yeah, I can see that a scenario like that happening, something like dollar yen dropping. Maybe we get down to 133, something like that. and then if we don't break that area, which is let's stick it on the chart, which is an area we've all been watching for quite a while, right down into this area down here. If we don't break through that, then we're going to be on the fundamentals, and if we keep getting good jobs reports and sticky inflation, that's going to keep the dollar underpinned because of those Fed expectations and playing the cut hold game that we're going to be in for from there on in. As for the UK and the quid, it reacted a bit to the jobs report and probably on the negative parts of it. But it did follow what other pairs did this morning. There may have been some of that additional volatility in there that we get between, or volatility difference we get between the euro and the pound, because this was already moving before the jobs report. It was already coming lower down to 125, and then the jobs report just accelerated that move, but we've bounced since. We did see the same in other pairs, as I say. Euro, yen came off a little bit and bounced back up again, as you can see down there. So we had a bit of a, I don't know if that was just some leftovers from Asia, maybe the 8 a.m. man coming in and doing some stuff, who knows, but we did see all those sort of similar moves in a lot of yen pairs. So yen, a bit of a driver again this morning like it was yesterday. But cables recovered more so than the other pairs, and I think probably the wages part of the employment data has done that and kept those Bank of England expectations a bit buoyant. What are you making of the quid here, guys?
I think it's pretty resilient. I actually didn't really understand the move lower this morning in the sterling, but then okay, on a second reading there was this 136k or whatever, and the articles, the ONS a bit alarmist also, for some reason, but on that was the reading then. But then on a second reading, I don't find it a bad report at all. I mean, there were people coming out of the jobs market apparently, but that happens everywhere. And no, I didn't see it as a bad report, and I still am of the view that the sterling is relatively resilient and keeps its how I call it elasticity. That is that it bounces relatively easy when every time it gets sold off. So I'm still keeping that little. It's not like a high conviction whatever bias, but I do keep that little bias. I'm still liking to buy sterling before selling it. Let's put it that way. Despite Bailey being in the UK.
I agree, by the way. And if you guys want, I can take the charts in a bit and show some stuff, and I'll show the sterling as well. And
yeah, I'll hand that over in a minute, mate. Yeah, no problem.
Yeah. I still think I'm constructive on sterling, not in a really enthusiastic way. Like just like Kay says, I have a slight bias for a stronger pound going forward.
Yeah, no, I actually do myself as well, which goes against my long euro sterling trade. But as you can see, even with all that noise this morning, not doing an awful lot. So this is looking at the crosses gives you a sense of, is there a real driver between the pound and the euro? Is the pound doing something more than the euro? And that's when you get sort of bigger moves like we've had in this move down from the 88s, all about the pound. But here it's a little bit more balanced at the moment, decent enough range, 40-50 pips, but coming through the jobs data and everything like that, it's found a bit of a bottom, or it's developing a bit of a bottom down in this 86 70s area. We are getting some little extensions, but for the most part we're holding this 86 70. Can't get a close and hold under there. So that's our marker from now. If we start to see it holding properly under there, then the pound is gaining probably across the board, and that's going to show in this one in particular. But until then, it's 50-50 what we do from here. We need to get above 87, this area here, 87, 17, 20, and hold it. So it's all about the holds in this ballpark at the moment, and that's the ones you want to go with.
Yeah, I think euro sterling is actually your less, how shall I say, less trade where you can be like really proactive. Although I still think that if you look at it from a wider angle, we are in a bit of a downtrend. I killed my squawk, sorry. But if you look at other sterling pairs, and perhaps I can do that tomorrow if Stelios is showing his stuff today. If you look at other sterling pairs, they look like, you know, you get dips, but then they come back straight away to the levels where they were before. Yeah, that is one. That is one. Despite what's going on in the yen on risk and expectations and whatever, it's of course it's a wide range or a wide channel or a wide thing, but we are a percent. Let's give and take a percent from the highs in sterling yen, where dollar yen is 7-8, no, more than 10% lower from its highs. You see.
Yeah,
and that's what I mean. If you look at sterling crosses, they do still have some yeah. It's just going relatively easy to higher data. And I just want to take a question here, Mike. What do you call the fundamentals to catch up with the pound? If you could. Talk about that. If you could be a bit more specific, what are the fundamentals that you think that will drive it one or the other way? Thank you. Stagflation. Yeah, but then you're looking at it around the globe, right? You can't isolate one country, I reckon, if that's what's going on in the world. And yeah, you can argue that then a sterling could be, since it's one of the risk currencies that the market is looking at now, could be a bit weaker, but that's going to affect all the currencies. I think that's a very big word, which with which the world will have to reckon if it happens, and not only sterling, for instance. But yeah, thank you, Mike.
Yeah, thanks for that, Mike. And yeah, you're right. You know, when you're looking at whether a trend gets tested, you know, that's where fibs come in, because you know that gives you an idea whether a trend's, and we're not even getting close to the 38.2 of this move up. We're holding where we need to hold. 24.50, been held about that. Down to 24s next, and the levels are playing nicely between in the intra ranges, if you like. The only thing I would say about this is that we are, and I said this after the Bank of England, it's going to be probably a struggle to get back up to these highs again, unless something significantly changes. So now it's a bit more balanced. You know, if you just take it from this last leg up, you know, mid-April, we're pretty much bang in the middle, and that's indicative of a lot of pairs.
Yeah, and
okay.
Right, if since we are on looking a little bit wider, it's very good from where you started the measurement there from the 118. We recall, yeah, we had this big level. We were turning around 117, 60, 70, or call it like even a bit wider there. You see that traffic area where we were talking about. We talked about that zone a lot, you know, when we were down there in those 117s, 118s. And then you start to move higher. And if you look at it higher, it really looks like those steps going up without putting the move really in danger, right? You're talking about a move which has been going on now for a couple of months. And it's not been put really in danger, this move, yeah? So that's your one, so your current 120.
Yeah, even if you take this big move from last year, you know, the dip didn't even get close to the 38.2 on that one. You know, that's your measurement. And, you know, again, with the same, not as big a move, but we can't even get down to those lows. So until that changes, it keeps the upside in play and the trend in play.
And it doesn't mean you have to go into the market now and go and buy sterling. That's not what I'm saying. I'm just saying that when the sterling comes off, that's a point of measurement for the strength, just the strength of a currency. When the sterling comes off, it finds bits, and then it rebounds and it comes back to prior levels goes like a little above there, and then it hangs around until the next move occurs, which could be up or down, but it just shows you that it's still there. It still has a bit of juice in it. Let's put it that way, as a currency. And then you can look at the cable, you can look at euro sterling, you can look at sterling process, whatever rocks your boat. But it's just to show you how a currency can behave, and that is why, and how I make my bias as well, is that I'm looking at it and I say like, well, you can't keep lows, and it bounces all the time. So there is something going on in the sterling, perhaps non-technical, perhaps just flows or whatever, that say like investors still like it, and that's what I mean by bias, and because we can't only look at just pictures, right? And make our we do look at it to have an informed ID, but you have to know that there's a lot of flows always behind there. We are only 5% of the market.
Yeah. And it's important, you know, you make an important point. It's not just a question of just, you know, shutting your eyes and buying it just because we're sitting there saying, you know, cable's well supported. You've got to pick your levels. You know, if you want to get in, you know, would you buy it here at 125.30? Well, no, because we're just below what's been a bit of a support and resistance area, 125.5, let's call it. So you're not going to buy it here, but you know, you get another move down to 124.50 and it looks like holding. You don't need to have a big huge trade. You know, we've got a couple of little extensions through 124.35, so you can have a 20 pip stop. If 124.50 doesn't hold, you can do 20 pips on it. If it does, well, you're back up 100 pips, as quite clearly shows on the price action. So this is what we do every day. You know, we can have all the bias in the world, but you still wait for your levels. You still plot your charts and you still say, right, I'm bullish, but where am I going to trade that bullishness? And you pick your points. And if they don't work, you don't need to give it a lot of room. And if you trade there and it breaks, fine, you look at the next level. Again, you don't need to you know, maybe down to this 123.5, which is another break point. And you trade down there, and maybe again you only give it 20 pips. And if it breaks, fine. You're having little losses. But if we are heading lower and then we start breaking the fibs and stuff, that's when you start to think, okay, maybe this bullish bias is changing. And then you look to see what happens on the upside. Maybe now we break 124.50, 124.50 becomes resistance. Now you know where you want to short it, and then you flip your trade around. So you can have a bias, but let the price action tell you what it wants to do. Don't just say I'm bullish cable and you keep buying it all the way down to 121. Well, quite clearly it's not fucking bullish anymore, is it? It's quite bearish. You know, that's where a lot of traders get caught out. They marry their bias. Let the price action tell you what the bias is, and trade off those levels. Stel, I shall hand it over to you, mate.
I thank you. Let me grab it. Grab it by the screen. All right. So clearly the market kind of indecisive ahead of all this debt ceiling talk, etc. So economic data still coming up relatively weak. We got I mean, you did mention everything, Ryan, but you know, things like the ZDW today and the New York Fed. I mean, that was the New York. What's it called again?
Empire.
New Empire State. Yes, I mean that was from a positive 10 previous reading, expected minus small, came in at minus 30 something. I mean that was disastrous, but it is volatile numbers, but still the picture is not looking very rosy, and this is one of the reasons why yields are having trouble bouncing. Because let's face it, you know, if things get really bad, we all know the Fed's going to start cutting again, unless inflation starts going up again, and that can have all sorts of effects on yields. As I've said before, 10-year is mostly driven by flow, but you know, fundamentals also come into it, especially as a short-term reaction. So 10-year US is still stuck. The lows 325, 326, the highs 360 and change, 363. As long as we're within those, you know, there's nothing to do. So if yields are not driving things, it's going to be down to the dollar, and it's going to be down to risk in general. And sorry?
Yeah, Stelios, if you can go back there and just as a question, so what is your take on the immediate impact on the three possibilities, right? So whether it be the short or the long term, well, you've spoken about the ultra short and the 1 month and stuff, but what is your take on those, let's say the more longer term, no deal, September deal, and then the usual, let's talk to each other next year. We've had enough pizza.
Yeah, well, I think the best scenario is the long can kicking. Well, actually, no. You're talking about the three events. One, they kick the can down the road to a year or two from now.
Yeah, like the usual one.
Yeah, one is they solve it. They agree on something now to raise the debt limit, and the other one is what to
No. I said no deal, September, or the usual one, which is see you next year, which is basically what we had over the past 70 years without sticking a date on it. But then next year we do it all over again. Yeah, 78 times in the past 70 years. So my question is, no deal. So that's default.
Yeah.
The September can kick or the usual. Let's talk again in a long while. I know there's a fourth possibility about some kind of middle of the road deal, but not agreeing on expenses and stuff like that. But what's the impact for that 10 year or so in your opinion?
Difficult to gauge, but the kind of long-term can kick, I think it's going to be good for risk. What does that mean for the 10-year? Man, I don't know. It's tricky. I really don't know.
It should be a sell-off, because if you look at what's happened between the 1 years and the longer the 1 month and the longer durations, and going back to that auction a week or two ago, where that 1 month yield really jumped, it's investors are moving out of short-term debt into long-term debt. And so that should in effect reverse but to whatever degree on a short-term kick or a long-term kick. But I think that the default situation, well, that's that's going to be a big exit from bonds, because who's going to be wanting to own bonds that can maybe be defaulting or not getting paid out?
Yeah, I think the clearest of the three scenarios is what you just said. I think yield goes a lot higher on a case of default, which is a little bit counterintuitive, maybe because, when things get really difficult, people flock to the medium and long-term bonds, because let's face it, they're not going to be defaulting on a 10-year bond. But I think the short-term panic is going to go and push the whole curve higher in yields. Now the other, like you said, the other two cases, as a move out of short-term into long-term. A move out of long-term into short-term, back into short-term paper should theoretically push yields higher, but I don't think it would be a significant move of any kind. I think yields are going to be moving significantly. If the economy goes really down the drain, it looks like the Fed's going to be cutting loads, or B, if inflation starts hitting higher levels. If we start going higher in inflation, sorry, my dog has actually slept over the cable of my headphones. Okay, I got it back. And it's a heavy dog too. What was I saying? I forgot now. Yeah.
If the Fed's going to be raising on higher inflation.
Yes. If inflation goes higher, then yields will have to follow higher. And I think we will see a break above that 360 something, and then we go towards 4%. But really, we have to see higher inflation. Even if the economy is not doing great, I think the Fed will keep trying to tame or to bring inflation back down, and they will kind of ignore the bad stuff and keep going with hikes.
So while we've got you in the mastermind chair, if there is a default, what do the Fed do about that? Because it's going to send borrowing costs through the roof, so that's effectively tightening financial conditions. Does that automatically put the Fed on pause, even
definitely
close to cuts on a default.
Yeah, well, man, this is uncharted territory. Yeah, theoretically, the Fed will want to counteract this, the effect of the default, right? So theoretically, they might even start. Well, let's put it this way: I think they will probably start buying up debt again. So they want to ease the conditions. How will they choose to do it? By cutting or buying or both? I don't know, but they will definitely want to do something to counteract. So my view is, if there is a default of any sort, that will be one of the best occasions ever to get to get long at some really good rates no, what kind of term paper, I don't know, but we're going to need to see what happens. But I mean, this is all theoretical, and I really don't think it's going to happen.
Now, see, we're leading down the rabbit hole now. You've got me going. Correct me if I'm wrong, but there was one of these ones, I can't remember, 10, 15 years ago, where they did actually get to the point where the federal offices shut down and they did hit the debt ceiling and bills couldn't be paid. Yeah. And it was 2 weeks, but they then have got emergency measures to carry on paying their debt. It's like an emergency toolbox. So even big headlines of default and we run out of money doesn't mean they're actually going to default and that they can't stop paying their obligations. They just break another emergency toolbox, I think.
Yeah, I mean, we had
2 weeks. It happened, didn't it?
Exactly.
Government shut down. We didn't get any data. Paychecks didn't go out, and that sort of thing. But it wasn't. It wasn't the US is bankrupt type situation.
No, and you hit the nail on the head. I mean, we had this situation 10, 12 years ago, whenever it was, and we saw exactly what happened. And honestly, do we think the US government is going to stop paying its civil servants and stop meeting its obligations? Absolutely no way. So even if there is not a default, but if there's a shutdown, like you said, there are other tools they can use, and just solve the situation until the whole thing with the debt limits gets resolved, which it will again. So they have to find a stopgap, just like they did last time. There's absolutely no way the US government wants to get into that kind of trouble, especially not with elections coming, et cetera, et cetera. It's just not going to happen. I mean, I know it's stupid to say this is not going to happen, and I never say something is 0% chance, but I think this is less than 1% chance. If it does happen, I'm going to be absolutely shocked. Absolutely. Well, anyway,
thanks for the answers. I'll let you crack on. I'll stop interrupting.
Yeah, no problem. No, it's interesting because I actually have to stop and think, and that doesn't happen very often. Anyway, so leaving yield aside, the dollar is the main mover now, and it seems to have bounced from these lows, 100.80, and actually took out these highs, 102.35. We're actually now right back within that level. So the dollar's kind of indecisive, although it's trying to rally. But let's face it, the numbers and the data are not good. So we have retail sales today. Let's see what that brings. But the dollar is trying, but these bounces are really feeble. So just like Steve says, he says, I wish the dollar would rally maybe towards 104. That will be an incredible opportunity to sell it there. I doubt it will get there. The only reason and way it will get there is if the market just gets really one-sided again and everybody's short, which means, it's going to get there. But for now, the dollar for me is still trading very heavy. Yes, it's rallied over the past few sessions, but it's really not convincing. So I'm still looking for reasons and opportunities to be shorting dollar pairs. But yeah, that's my main view on the dollar. Let's go. Let's have a look at the pound, which I said I would. So the cable for me is still bullish. As long as we're above this, we broke above this channel, and we, even these highs here, we're basically, we're about 100 pips above those previous highs. So, it's still looking good. It's not rallying into the stratosphere, but it is constructive. And the same applies for Europound, which is broken below these lows and it's kind of retesting now. And well, it did retest once and it's now dropping below. So as long as these two stay, so the Europound stays below, 87.2, 87.15, let's say 8.72, and as long as cable stays above, well, maybe the channel is a bit too low. Maybe, anything above 124.2, let's say, I think I would call it still moderately bullish. I don't want to say excitedly bullish, but moderately bullish. And I still think this is the case for the pound. And if you look at other pairs, other crosses, sterling Kiwi has been trading very technically. Let me take this out of the way. There is a big resistance area here between 203 and 205. It's ventured there a few times, but it's still bullish. It's still the retracement here. Actually, what is this retracement? I haven't looked at that. Let's have a look. Well, there you go, 23. Oh no, we've got that to the 38.2. Funny how technicals work. We're still bouncing. So the sterling overall remains one of the currencies that I like for this year. I'm not saying I think the UK is going, all cylinders go, etc. No, but compared to other currencies, I think it's probably not going to do badly this year. I think it's going to be one of the outperformers. Now, I'm still looking for dollar pairs to short. USD CAD is one, which is really clear. I needed to break below 133.3. We're not there yet, so I'm just waiting on that. Dollar MEX is an absolute. Remember, we've been talking about this for weeks, and we said, when these lows here got taken out, which was 18.5 or something like that, we said, right, this is it. The move is starting, and look what it did. It went down to 17.9, then took all the stops above, and then we have the proper move. So this is the way markets can really annoy the crap out of you and stop you out before actually doing what you expected them to do in the first place. Dollar Norway is one I really like. You all know this, but I am being patient and I want to wait for the market to come to me. 1082, 1080, low 80s. I'm definitely going to try and short. The problem with this is that it's affected by oil and by risk in general, and it's affected in a really big way. So not for the faint-hearted this. I tried shorting a couple of weeks back, got stopped out at minus 0.5%. So I'm licking my wounds and going to have another look at it if it gets there. Okay, so risk, equities. What have I been saying for the past weeks? If I was short risk, I would be very worried. It's still trading sideways. Look at all these indecision candles, one after the other. If I show you this chart, what do you think? I would say this has to retest 4,200. It just absolutely has to. Unless there's a black swan event of some sort or something happens. The question is, obviously, if there's a default, this goes south. I mean, it's I think that's a given. So there is always this risk, and this risk is priced into where we are trading now. I think if it wasn't for this debt ceiling malarkey, we would be at 4,200 already. And when we do get there, and if we do break out, we take all the stops, we go to 43. I mean, that's previous high. I think that's the path of least resistance, and my view is not changing. The DAX is looking better. I mean, look, we're almost making new highs now. We're threatening for the last few sessions, and we are, let's have a look. Well, we are about, wow, 400 points from all-time highs. Incredible. If you think about what's happened with rates and inflation over the past year and a half, absolutely incredible. But this is the market we have. It's a bullish market. I repeat, I am not a perma bull or a perma bear. I think that we should be taking fundamentals into account, and fundamentals will say that equity should not be up here. They should be lower. But fundamentals are something that can take months and years to play out, but market action tells you things every day. And for the moment, market action, the tape is telling us that you cannot be bearish. You just cannot be bearish. The DAX, actually, you can be bearish, but your stop is going to be really close. Because if these highs get taken out, you know, where's the next level? We go to all-time highs. So I will be very cautious if I was short risk, and if you are, please size accordingly, put your stops, and yeah, be extra careful. Let's have a look at cryptos as well. Well, Bitcoin actually is the one that trades the most technically, and I like it more than everything else. It's also the most liquid one, so I always concentrate on that when I'm talking about cryptos. And we broke below this wedgie thing. Came and retested. We're still below, so as long as we're below, this is now not looking very good, and it's this goes at odds with the general risk environment, because I think equities are bullish, but for the first time in a while, I think cryptos might be diverging. Do I think crypto is going to drop if the S&P goes to 42 or 4,300? No. I think they're going to rally, but they are definitely underperforming, and you have to be aware of that. So if there is a risk-off move, if we do see stocks moving lower, I think cryptos are going to move lower ×3. So and the next level in Bitcoin is 25K. So I think this 2K area is going to be filled probably maybe even within a day. You know, it's going to be pretty violent if it happens. But for the moment, they're trying to hold on, but underperforming. So I'm not trading them. I'm just looking at them and giving my humble opinion. Oil, I'm going to repeat, I have no intention or will to trade this bloody thing. Too many factors, too many things influencing it, and frankly, I really don't know what to do with it. So I will let that be. Let it be, like the Beatles said. Or was it John Lennon? It was John Lennon, wasn't it? Anyway, that's it for me. I'll leave it at that.
Thank you very much, mate. Great stuff as always.
No problem.
What have we got coming up today? US retail sales is the number to keep an eye on there. That's going to give us our next view of bits and pieces as far as the consumer is concerned. Also, we've got Canada inflation apparently as well. So one for the BOC. And I've got a sneaky suspicion the BOC might pull a bit of an RBA. Just the way they've been talking recently has been a bit more on the hawkish side. So any upside numbers there on inflation, any beat of those expectations or not dropping as much as expected, I think the Looney's going to see some action definitely there, and expectations for the BOC. Just a little bit of a gut feeling I've got there. You got any thoughts, Kay, about today's data? What we're likely to get?
No, the few expectations I saw from the banks were relatively in line with what the Reuters or whoever would be expecting. We don't see your screen though, by the way, if you were sharing anything. But so famous last words is probably going to come out a completely different picture. But no, I don't really have any expectations. Now, just this being
is that working now on my screen?
Yeah, you see it now.
Yes, it is. Yeah.
Yeah. Now, this being said, if the consumer holds up, we know it's usually big positive risk, and big positive yields at the same time. We have seen those things go walk hand in hand lately. So yeah, probably a bit supportive for stuff like dollar yen, perhaps. Bit risk should do a bit better, and then Canadian CPI, absolutely no idea what that should come out. On the Bank of Canada, I thought they were like McClellan was trying to do everything he could to signal a pause, but yeah, perhaps they will be forced in doing something. But they are already at 4.5%, right? So if it comes out, is it 4.5? Yeah. So if it comes out anywhere close, that should not really push them too hard to do anything more. So yeah, lately it's really been moving on and off with what the oils are doing from in the distance. Yeah, I think they are at 4.5 indeed. So if it comes out there, like their core around 4.4, 4.1, 4 point whatever, that should be pretty neutral right now, I'd say.
Yeah, thanks, mate. Yeah, they do like to have about 8 goes at guessing inflation there, as you can see from those different numbers. So keep an eye on these medium, trim, blah, 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 blah stuff going on there for your fix. Just looking at the rate expectations, the probabilities are 90% for unchanged and 10% for hiking 25. That's the BOC there. And yeah, the US data, got to look at all the X stuff as well. So remember to factor out the big ticket items and looking at those core sales too, the control group gives you a better underlying picture. So that's what we've got coming up later anyway. As always, thank you very much for coming to the Flow Show and your continued support here. Good to see you all. The numbers increasing. Don't forget to give us a like on the old Twitter and a thumbs up and a retweet and everything. Spread the word what we're doing here. Thanks as always to Kay and Stel for their valued input. I will see you folks next Monday because I'm off for the football tomorrow for a couple of days. So I'll leave you in the very capable hands of Kay and Stel. Yeah, thanks everyone, and have a great time. Make loads of pips. We shall see you all tomorrow.
Cheers, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.